Welcome to the Twomey Stock Market Report. I'm James Twomey, and today is July 17th, 2022. Well, it's been a couple of weeks since the last report. Some comments on that a little bit further, been on some travel, and I did have some really interesting observations. But let's first go over some news flash, and we'll come back to that. Year over year, inflation accelerated to 11.3%, the highest on record since 11.6. That's the producers, right? Not the inflation index that we just recently came out at 9.1. Producers produce the goods. If they have to pass on cost and they can't absorb it, they're going to sell their products to stores and people at a higher cost, and hence exasperates inflation. So that's really heating up. Our annual inflation rate, 9.1%, highest since November of 1981. With gas prices coming down, I don't know how much it will affect energy prices, but that may level out some of these inflation numbers. But the producer index being so high, I don't necessarily see inflation dramatically coming down. But time will tell. Energy costs rose 41.6%, the most since April 1980. Food prices jumped 10%, the most since the same time period. Basically, consumer spending drives 70% of the gross domestic product, right? So will people abate their spending with these inflation numbers staying high? They're sticky at this point. They're not going away quickly. So the answer to that is yes, people are going to start pulling in their horns and not spending as much. They're not going to buy big ticket items. They're not going to invest in areas that require loans that with higher interest rates. They're going to wait and see this smooth out. So the savings grace or the next shoe to drop is the question. U.S. ISM manufacturing. That I watch that as one of the four pillars of recessionary or negative economic impact, and that's at 53. It's down from 56.1. However, it was 60.6 a year ago, so it's definitely running lower. Typically, when that reaches 50 or below, anything below 50 is a contraction and a slowdown. We haven't quite hit that yet, so that's a good sign. Also, unemployment is still very low. Bloomberg initial unemployment claims increased 9,000 to 244,000. That was the week July 9th, but the medium estimate was called for 235. So we're okay there. Basically, if people do not get laid off and prices continue to stay high, essentially people can find a way to pay for it. If we have an increase in hiring demand, a decrease in hiring demand and eventually layoffs, that's where the next shoe to drop, because that certainly eats into people's spending habits if they don't have a job or they're on unemployment, which is a lot less than what they were collecting on a regular paycheck. We haven't hit those numbers yet, so more to come, more to watch. And if we are at a bottom in the economy cycle and inflation either stays or abates, and as long as the company keeps hiring and retaining jobs, we'll weather this uncomfortably, but we'll weather it. It, of course, impacts lower income people the most, and that is going to be very interesting because they're going to put a higher pressure on wages, and if wages go up, it's a spiraling effect, obviously, of inflation. Now, some of the things that we have to watch is Silicon Valley. I was out in California. I was reading up some local news. Definitely high tech is pulling back. They're not hiring as much. They're cutting certain jobs. Plenty of engineers supposedly available. I'll believe it when I see it. But something to watch. 81% of the stocks in the New York Stock Exchange are now trading below 200-day average line. What does that mean? Most stocks are really pulled back. They're in negative territory for year over year. And then in addition to that, one analyst who's very well known came out and said, that's a great number because it shows most of the stocks are beaten down. However, last recession we hit the level of 100% were below their 200-day average. So what does that mean? Maybe some more to go, or the leveling settling out. One wise person once said, I followed it many years ago when I was young, and it was on the radio. His name was Bob Brinker. He said, stocks can do three things. They can go up, they can go down, or they can go sideways. Really not a lot of insight there because it covered all the bases, but that was him saying the sentiment is, if a market goes sideways, that's probably a good thing because we don't know if it's going to go up or go down, but we certainly can start sensing the trend from a macroeconomic perspective. Okay, 30-year fixed rate mortgage now at 5.5%. Last year was 2.88 actually. Okay, so what is that telling us? No more sellers left. What is the current stock market sentiment? Let me just give you a kind of a Twomeyism. We did a lot of travel the last several weeks. We took a lot of flights, actually 6 flights, and we took Southwest, which is not the best because I looked at them as more regional, so you got to make stops where others are direct flights, but only one of those 6 flights were late, and it was, it didn't depart until about almost an hour later, but we arrived within 15 minutes post the actual arrival time. So they made up time in the air, et cetera, et cetera. So what does that tell you? Southwest has figured it out as far as either that, and all the flights were full. There was no doubt about it. It's travel season anyways, but Southwest is going to figure out the staffing problem that they had a while ago. Now it seems to be hitting Delta. So the other thing, so what am I saying there? These airlines are starting to figure these things out, and they're moderating their flights, their size of their flights, and their staffing is starting to moderate. That's a good sign because if they can handle this surge after the pandemic, we might have some abatement in cost of airline prices. However, the fuel prices are what really drive that right now. The other thing I noticed was, with Southwest, which usually take other airlines, but Southwest, since you can check bags, there was less people putting stuff in the overhead. There was less people waiting to get their seats, and there was less people trying to get up into the bins to get out. Made for a smooth transition in and out. Now all these airlines, JetBlue, you're charging for check-on, your carry-on, charging for your check bags, et cetera, et cetera. They're not the only ones. It just causes for such delay for boarding and getting off these planes that it's a nuisance. So I always said, I used to travel a lot, and I stayed at the Marriotts. I still do. They used to charge you if you got on the internet. I always write they ask you for feedback after your stays. I always write a comment. I said, we all need internet. Just roll it into the price and make it transparent. Nobody wants to have to check in, put their stuff down, and then open up to catch their email. They got another charge for coming at them. Just roll in the price. We're going to stay there one way or the other, right? And now, of course, you get it for free. So, all right, back to our story. The U.S. investment sentiment bullish is 27% compared to 19% last week and 40% last year. So, there's a little bit more bullish sentiment out there, obviously, and we've seen that with some stock market rallies. But if you look week over week, even though the stock market had some gains on certain days, overall the major indices were negative for the week. So it's short-lived rallies. The AAI Investor Sentiment Survey. Individual investors surveyed displayed extreme pessimism. April included the lowest number of bullish investments in over 30 years. The spread between investors who are bullish and those who are bearish reached extreme levels not seen since 2009. So could we interpret that as there's no more sellers left and we're going to see the market fits and starts, but maybe overall sideways for a while? Could be. When bulls drop below 20%, it tended to be a contrarian indicator, so that basically it meant short-term gains are ahead when the number of bullish investors have fallen below 20%. The forward 3-month returns have been negative only twice, and the forward 6-month, 12-month return, 6 to 12-month returns have been negative only once, and that was during the great financial recession. So if you've watched CNBC, Bloomberg, Fox Business, whatever it is out there, and reading, Invested Business Daily, etc., you're getting this sentiment. Oh, everybody wants to rush to say we're near market bottoms. There's great buys out there, some really quality stocks. We should be, if you put them in your portfolio, you're going to hold them on for 3 to 5 years. You're going to come out in the pink, or on a green, if you will, in the future. So the sentiment is, hey, it's not so bad. One of my kids called me the other day and said, hey, I'm thinking about putting some money to work. I got plenty of years. Things are so low. So you can see the mental sentiment that started out there. It's the programming, I call it. Yeah, we'll see. I mean, it certainly is a much positive environment for investors out there. Chicago Board Options Exchange. Okay, so what else do I look at? Put call ratios. It's at 0.96 typically when the ratio rise, 1.2 and or 1.3. That's where we see market bottom. So we're not quite there yet. Volatility index. There's a lot put into the volatility index. In the old days, it was much more of a predictor. Now it's more of a follower. It's kind of after the horse is out of the barn, but that was at 24.3, still high. I mean, above 20 kind of says there's contraction of buyers, but anything, usually a market washout is around 40. I've said this before. What really is an indicator is when the Fed says, "Hey, we're gonna abate raising interest rates for a while." We haven't had that yet, and they're only coming out. 0.75 and 1 is being bandied about. They're committed to fighting inflation. Powell said, we're full steam ahead, even if it crushes the economy a bit. People have come out there. I forgot the name off the top of my head, but it was Larry Summers, and he said, quite frankly, we need unemployment the next 5 years to reach at levels of 5% in order to knock down this inflation. He said, or in the next couple of years, it's going to be 6.5, 7%, or 10% now. I think Larry Summers is a pretty bright guy. He served in Washington. He's in Harvard. He's got a pretty decent track record of being honest out there, if you will. So everybody in my mind is saying, hey, unemployment's low, so we're not going to have a bad recession if we have a recession. So far, we have to agree with that. However, if that shoe drops, people start laying off, we're going to be, and the manufacturing index will start to fall. We're going to be in some long-term malaise, but we have to wait for that to happen. All right, so sell-buy alerts. A lot's gone on the last couple of weeks. Basically, short story, I'm holding a third of my positions in shorts for RWM, SH, and DOG, the Dow, the S&P, and the Russell accordingly. And, at this point, we'll go over some charts, market kind of going sideways. It may go up, may go down. I'm willing to hold that position. I'm mostly cash and everything else. Mutual funds, mostly cash, except for a small percentage. And I just don't want to get awash in these spikes up and down. Volatility is still there, but the market goes up 600 points one day, goes up 300 points the next day, and the next thing you get a big downdraft. I mean, there's no, and we'll go over all this as far as some of the technicals. UNH rebounds. It's been bouncing between 500, and then they came out and had great, and 518, and then it came out. Earnings last week were fantastic, and it bounced up over 523. So if you still held that, that's great. If you just stopped out, it's the sign of the market. Energy entries and stops. I had seen energy dropping, and we'll go over that, our screener index, and I did short the market with SCO, which is 2 times the U.S. oil barrel. I'm fully out of that now, but I did take some decent profits there. I didn't wait for the negative crossover, and I will maybe reconsider that, or I believe I might have taken a small position Friday. I have to catch up. TLT, I took a small position, added to that position, sold it off. I'm back in it. TBT and TBF, I got a small position in TBF I added to, well below the negative crossover, positive crossover. TBT I got stopped out. So that is still showing that the 20-year Treasury yield is not rising as high as we expected, as it did back in the financial crises, which is really interesting. So something to watch. The XLV, it's crossed above its and has retained above its the 9 and 10 EMA, so that's still showing positive. It hasn't really taken off. It's kind of going sideways. XLU, it's nearing its 914 EMA. I have a new dividend play, PAA. It's a mid. They supply They are a pipeline for oil and gas. They go from the producer to the businesses and consumer, U.S., Canada. It's running about 9 some odd percent. So therefore, if you get it, and we can look at it right now, you could probably withstand a point loss because it's running around 10, I believe. And it kind of goes sideways. So, I would say it's like Verizon. You've got money to play with there. All right, so let's look at the weekly. It's a little bit easier. If you look at the weekly from our beginning of the year, 2022, it was high of 10.9, and then it peaked at around 12. And we had another high that was around 12. And the low is recently, it hit a low of 9.10, and now it's closed at 10.2. So if it gets a 10% yield plus or minus, it's at these prices you can afford to go down to 9 and still break even. If you look at this weekly chart, I mean, since mid 2020, it really hasn't changed too much. It had lows of 5.6, and it got up to around 9.5. So since December of 2020 to now, it's been flat. That's a pretty good history, right? Do we expect much on that? Didn't really peak too much during the energy. 42% increase the first 6 months of this year. So it's what I'm trying to say here. It's consistent, and you may want to take a nibble here. I'm getting into this. The 9 EMA is well below. This is the daily chart now, below the 14 EMA. So we don't have a buy signal at all. The 120 has crossed. So. And then look at the stochastic way up over 75. The MACD is just crossing above positive, above 0. Not as high as we'd normally like to see to make a mouse hunt entry, as I call it, here on the 120. But basically trading the 120, expecting to get some flatness here or the same, and then at the end of between now and the end of the year, get some premium on my yield of dividend play. Translation, I'm trying to look for, I don't know where the market's necessarily going to go. I'm not in the prediction business. I look at the trend analysis and the performance of companies and the fundamentals. And right now I'm sensing that we're probably going to maybe get some short rallies and some pullbacks, maybe sideways overall. And I'm looking for ways to generate income without committing to a 5-year or 30-year treasury. Okay. Lot there and a lot to cover, but let's go back and look at some of our other data here. So that's it. I would get in PAA for the dividend play. Also, I'm looking at some bond ETF funds, corporate and U.S. SPTL is the yield performance for that tracks the long-term sector of U.S. Treasury market. So it's a U.S. type play, right? And SPTL, let's take a look at the graph on that. SPTL, you got to be cautious with this because if yields scream up, look, as you can see, the beginning of the year, we were way, this thing had a price of high of 42 and it's down into 33. So Are we in a short-term bounce? This is the day bounce. This is the daily. We've had one, two. We haven't even gotten three recent highs, but if you noticed, we've had confirmation. We even had a draft down of the 9 crossing the 14 EMA, so it's a positive buy signal. It's starting to come up and hit our 50 EMA, and it's well below the 200. So you got to be cautious here, but there's been some movement, and can we get up into the 34, 35 range and make a few points? I believe we can, but this is a place to park some money, and looking at it won't move too fast. Let's see if we've got a SPTL. If we've got I don't believe the yield is too high on this. Let's see, dividend. Dividend's 2.2. Not too bad. Not too bad. Okay, so a good place to park some money. VCIT is a Vanguard Intermediate Term Corporate Bond Index. It really tracks the performance of Barclays U.S. 5 to 10 year corporate bond index. So this is a corporate play. I'm shorting junk bonds, right? So I'm looking for junk bonds to take a hit. So this is a little counterintuitive, but VCIT. And we'll look at what the top 10 holdings are. VCIT. Again, I'm looking for a place to park money. If we look at the weekly, the trend, obviously down from the beginning of the year. It's straight down. Are we at the bottom? I'm getting a short-term bounce. Well, it did cross over for the 9 or 14 EMA, and it did confirm even on a recent, downturn. So we've got confirmation. The trend is slightly up. So therefore, we got the all-in buy signal. Again, place to park your money. The dividend on VCIT so far is 3.5. So I'm looking at, hey, I've got some chances to park some money during this malaise, and if the market goes sideways, I'm making some money, not a lot, but it's a place to park my money. If the market tanks, these are going to come back down. So it's double-edged sword. If we look at what other SPLB, that's the performance of its 10-year sector of the United States investment bond market. But let's look at VCIT first. VCIT. And I use Schwab Street Smart Edge. I think it's a great tool. It's got a lot of information. All right, so the VCIT, top 10 holdings, U.S. Treasury, T-Mobile, Bank of America, Magellan, Bank of America Corp, Verizon. So, certainly domestic bonds, 83%, a pretty good one for corporate bonds, right? They're pretty safe. SPTL, that's the U.S. Treasury, no surprise there. Treasury bonds, right? All different maturities. So no surprise there. What was the other one we looked at? SPLB. SPLB. This one, again, it's a little bit of an overlap with the VCIT. So if you want to choose one, that's fine. I like to give choices. This is Anheuser-Busch, CVS, Magellan, GE Capital, Goldman Sachs, Wells Fargo, AT&T. All AT&T's got a huge dividend that they're paying now. So these are things that CVS, these are all areas that you can feel that the corporate bond is going to do pretty well, right? Do pretty well. Great place to park some money at this point in time. I'll also add, for those investors who's got cash, I-bonds, you can put up to $10,000 a year or as little as $25 per investment, so you can do it over time. Go to US Gov, look for I-bonds. They have their own website. It's a little tricky to fill out the forms, but if you're young, it's not. You can put up to $10,000 a year, and I believe at tax time you can add like $4,000, but I'm not sure on that. So if you got a spouse, you and your spouse can each put $10,000. It's 9.something% now. The next 6 months, if you get in the next couple of weeks, it may even go up. There's some caveats with that. If you don't, you have to hold it. It's either 2 or 3 or 5 years. If you do sell it before that, you lose some of the interest that were accrued. It's all in there. It's a little funky, But these are kind of things you want to buy and hold for a while. If you got some disposable cash, you buy these I bonds, you leave them in there for the next 10 or 15 years. It's not IRA money, so it's only real cash. If you get the next couple of years 5-10%, and then it goes down to only 0.1% for a couple of years, hey, not a bad place to park your money. So that's another good suggestion. All right, let's go back to some of these holdings. All right, we want to go over some of these stock plays. Let's look at, since we're on the bonds, TLT versus TBT. TBT first, the short of the 20. The short, we've been well below the 9, cross below the 14, or 10 below the 15, whichever you want to use. The stochastics have been running down. The MACD is down in the bottom. We did have a little short run up, but it didn't quite cross positive. Did some buy at that point. Stopped out as of Friday, actually. So the trend on this one, it continues to be down. The weekly trend, if we look at it, there's a little bit of a, we haven't quite hit the 0.382 retracement, but very near there. Yields should still be going up, but they're indicating that, basically telling the market it's an indication saying to the market that, hey, things aren't so bad, and we don't see the Fed raising rates much higher. I don't know. I didn't expect this. That's why I'm not in the prediction business. So keep an eye on it. If it goes sideways, it might be for another pop up. TLT, and that was the 2 times, versus the 1 times. TLT, we got the crossover. We did have some pullback to sell, but it then rebounded, and we're still positive. So this is, if you're in TLT, it looks like we've got, look at this. Our MACD is well over 0, and it's climbing. The stochastic is up over 75. All good signs. And any selling has been met with some buying, but we still haven't crossed over the last high. Maybe going sideways, and if it does, expect it to retreat back below our Twomey trend track line, and if it does, get out. But that's something to consider. What else are we looking at? UNH rebounded. That was a nice surprise. Of course, healthcare, and we'll go over our sector analysis. It would have been nice if we held it, but right now it's probably, it may get back up into the 550s, but we're definitely in a positive cross. If you get a pullback, you want to play it, that's fine. XLV is not really as promising. It did cross above. They had some major washouts. It's bumping up to 200. Can't seem to break that. So it's overall healthcare. It's UNH is a stellar performer in the healthcare market. Let's see what else we're looking at. Okay, XLV, XLU. Before we get into our shorts, XLU. Let me close this out. It keeps popping up. XLU is our utility ETF sector play. Generally, people who go into utilities, if they look at that as being a way to earn dividend capital, if they don't see it if treasuries go up, get good yields, they get out of this and go into treasuries. More predictable, right? XLU is making a rebound. Yields are coming down a little bit. But they have definitely gone sideways the last week and a half, almost 2 weeks. So this may, and it's, right now it can't seem to shake past this 200 EMA. It's, even though the 10 and 14 have crossed positive, it's basically sideways move. Anything that's been going sideways in this market the last 6 months usually turns out to go negative, right? So you get a rally, goes sideways, and then whoosh, we get the big downturn. But it's usually news driven, and we don't really have much negative news coming out. We've had some companies. Early this week was J.P. Morgan, was it? Came out and said they put 28, a ton of money aside for bad performing loans, etc. Hit the market. Then Citigroup came out and they had good earnings and some other good earnings out there. So as companies rearranged their earnings estimates to be lower, then they come out and say, hey, we hit our earnings estimates. So no surprise, but they're still earning less than they were previously. So, good news is sort of bad news, right? So you have to be careful with that. All right, so we're going to look at diamonds. This is the long of the Dow. Have we crossed? The 10 and 14 EMA is still negative. We haven't got our all buy signal. It's bumping up against the 2-minute trend track line, well below the 200. There's the 50 EMA. The MACD is, the stochastic's up. The MACD is cross positive. It's still below zero. But if it breaks above, we can certainly see it go up to the 50 EMA at around 317. So the dog, which is the short of that, is, we still have the 9 above the 14. We've had some rallies, but they've abated. And again, we see this sideways move 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 weeks. So it's kind of range bound for the last 3 weeks. Not surprised, summer, low trading, etc. It's bumping up now above the Twomey track line. It did cross above it. This is short term now. This is a daily chart. And then it came down and didn't act as resistance. So this is probably saying, it's going to be range bound, probably somewhere between 34, 35 to 36 and a half. The relative strength index, what are we seeing there? 48.6, not telling us much. SPY, what do we got here? All right, Twomey trend track line, it's certainly hit the lows of that and kind of retaliated upwards, but it's not going anywhere. It's again sideways the last 15 days, plus or minus. So nothing really big on those rallies. It did cross the Twomey trend track, and it looked like it was going to cross positive. The 9 and 14 looked like it was going to cross positive. Didn't quite make it and inflected down again. Relative strength index on that is 49%. Not oversold, not overbought. Sideways. So, another reason to park money until something changes. The short of the SPY is the same story as the Dow, so nothing different here. You can look at it and see what's going on, but the relative strength index is 49.6. Bumped up against the Twomey trend track line short term, albeit, and then it went above it and then came down below it. Now it's acting as resistance. So range bound for a while, which we'll see where this goes. I'm going to hold for a while until I'm willing to even incur some losses. We'll see what goes on as time passes, right? All right, so RWM. Yeah, let's take a look at that. While we're on this. IWM is the long of the Russell 2000. That same story as all the others as far as the 9 and 14 EMA. And then, of course, the relative strength index, 48.5. No new news. Sideways move there. RWM, sideways move there. The 9 and 14 are flat. Nothing telling us to buy or sell. I'm still holding a third and willing to take some. I'm going to watch this range bound for a while and see what goes on. Let's see. Is there any? Let's see. I always SPJB, is it? No. Why do I always forget this one? SJB. All right, let's look at SJB. This is the junk bond, right? SJB. So if corporations, the ones that have a hard time raising money, have to pay higher rates to attract money, people go there when the economy is pretty good and yields are low and they're not getting much from Treasuries, but they want to get some positive returns. A little more gamble, but in a safe market, not a bad deal. You can do pretty good. This has not, really, it's not moving much, but it has come down and hit the 50 EMA. Is starting. It looks like it's starting to cross negative. It just did on Friday, so we'll wait another day or so. If you're in that, it can't hurt to sell, because your 9 EMA is below 14. It looks like the Twomey trend track line, it's hard to say, but I would guess it's even though it's short term, it's based on everything else we see in the market. Um, it's not going as much sideways as we expected. It should. It's dropping a little bit. Um, you may want to get out of it if you're in it. Okay. What's the relative strength index? 43. So nothing positive there. But anyways, that's saying junk bonds are not getting hit during a recession. It will. It's something to watch, but you don't want to ride it down all the way here to 18. So if it next day stays low, you may want to get out if you're still holding. That would be my recommendation. All right, what's our sector table? Look at this. I sorted this by 6 months. Energy, number one, 6 months, 2.1%. How many times we looked at that? It was up in 45, 42. So energy is, from a stock market perspective, is falling dramatically, right? Year to date, it's only up 13, 14%. Let's see, the last 5 days, negative, still negative, okay? 6 month we're looking at, is this sorted by 6 months? And healthcare, 0.28, so that's a defensive play. Utilities, defensive play, -3, -0.2, -3, -8 for consumer, real estate, -14, and it drops from there. So let's look at that to like the last 5 days. The only positive is really consumer staples, even healthcare, -0.35. So, things are still rocky, right? Let's look at 1 month. 1 month energy down 13%. So we haven't hit the bottom on energy, it looks like. Healthcare +8, utilities +1, consumer staples +4, real estate +2. Pretty much all defensive plays, information and consumer discretionary. So, no doubt people are getting in the market, but if they are, they're looking at high value companies that are giving them defensive positions. That's what that's telling us. Okay. Nothing really earth shattering. So, advanced decline, if we take a look at that as of Friday's close for the New York Stock Exchange, it's still trending sideways, right? Sideways, right? We did try to get some increases, and they, just can't get above or near the 50 EMA. The MACD is at, can't quite read that, 46, relative strength index 46.8. It's bounced off the bottom, so that's telling us kind of a neutral, right? 30s oversold, 70s overbought. So we're going to, this is another indicator of the sideways. That's all. That's all it's telling us. You want to look at that over a macro trend anyways, not just short-term day-to-day. Some people try to trade day-to-day with that. It's a little bit tough. We do have some support levels we earmarked out there. Still some pundits calling for the S&P to be at 3,400 level. We're at, 3,800 now. So, certainly some room, but not a lot of room to go down. My guess is we're going to go sideways for a little while and then determine where we have either one more washout or until the market is, declaring no more interest rate hikes. So we're going to see where that takes us. Right now I'm looking to park money, and I'm looking for dividend plays, PAA, Verizon, maybe AT&T. You look at the yield for a year. If it's around, let's take 10%, it's easy math. And if the stock is at 40, you can endure a 4% pullback and still break even for your entry. On a $40 stock, 10% down is $4. So you're going to break even on that pretty much, right? So you want to look at things where it's not at its high for the last 6 months, but the lower it goes, the higher the yield. As it price increases, the yield decreases. So you have to watch that a little bit. But Verizon, PAA, AT&T, there's a host of others out there. Good place to park your money for the next 6 months. Those corporate and treasury bond as long as they stay sideways and don't drop dramatically, good place to park money. TLT, I'm going to ride that until it goes away. SCO, let's look at the short of oil. SCO, let's go to our Stark chart, daily chart. That, I believe, yep, let's make this bigger. Yep, see how the 9 is well above the 14 EMA? We've kind of hit a little bit of an inflection point for four highs, somewhere after four highs, you can expect recent highs from the lows. You can expect a potential pullback or sideways move. And then if it continues to grow from there without going below that last fourth candle, you can expect it to go maybe up to 6 or 7. So more to come on this. It's riding above the 9 EMA. The Fibonacci retrace is hit 0.382 on Friday. This is a 2 times. So the U.S. barrel of oil, it's the shorting of oil barrels saying prices should come down. And it gives you, it fluctuates either. If the number was 1 for the day on that stock, this would get you near 2. If it was down $1, get you down -2. So it's a riskier play. You got to take your profits when you get them. I certainly, took them ever since it went positive there. It's still positive. I went back in, and then I'm going to watch it. And you got to be careful because it does swing violently, but energy does. And as long as this is kind of a gas pump indicator for me, I go as I see, especially the low costs. We've got an area here in Massachusetts where there's a section and they all kind of compete up on Route 1 North. So a lot of times if I'm driving that and I see they're all dropping down one after the other, day after day after day, by a penny, 2 pennies, 3 pennies, that tells me they're going to, and then the big guys start falling. That's when I start shorting oil, okay? Kind of a pocketbook investment type. As soon as I see it, stay flat or go up, that's when I get out. That's some philosophy that, some science, some fundamentals, some guesswork, right? So what are we seeing here? We're seeing a sideways market. We're seeing a place that we could have summer trading going on right now, light volumes. The interesting aspect of when I look at, the bull-bear ratios, the put-call ratios, all the VIX, yields, they're all pointing towards, a little bit of declare victory, that, this is it. I'm not in that camp, so I'm cautious, but I'm also not going to let my bias tell me, lose out on a good game. But my guess is sideways, and then we want to capitalize on sideways by taking these corporate and bond plays, I bonds. We want to also capitalize by taking some fundamentally good dividend yields, at the bottom and lower numbers here. We want to get in on those. We certainly want to watch oil. We may want to short it. If it starts to creep up, that's a good time to get in. Actually, I'm still long natural gas U.S. Part of that is because of the shutdown for fixing pipelines over in Russia, and hence Europe's a little worried they're not going to increase the flow again. We'll see. In the meantime, I'm trying to maintain some shorts. I'm not ready to go all in. The market, once the Fed says, hey, we're going to slow down interest rates or stop them, that's when I'm going to go into my mutual funds, add 50%, go long, and just, and I'm willing to take a little bit of market increase while I'm neutral or heavy into cash. Not a problem. And my stock plays, every time I get into something long, 4, 5, 7 days later, I get stopped out. I've got, stops below the 10 or 15 EMAs, and then it kind of bounces back. That's a sideways move market, but I'm always disappointed in long plays. My short plays, yeah, I'm losing a little bit now, but I'm not getting killed because I've been up all those on a positive percent. So that's the Twomey Stock Market Report. We'll try to add some more flavor to that. Look for the future. We're looking at kind of changing the format a little bit, getting much more of a on real-time on-demand website for you so that you can start looking at some recommendations and making your own choices, as well as giving these weekly updates, some videos, some written, so you can look at them at your leisure. These are getting kind of long on YouTube, and I know that that's not easy for people to follow. Have a great week. We'll talk to you soon, and happy trading.